By the end of this course, you will be able to develop a solid understanding of the use and limitations of technical indicators when applied to financial markets. Become proficient in selecting and applying technical indicators to suit different trading styles and varying market conditions. You will learn to interpret indicator signals effectively and integrate them into robust, data-driven trading strategies. Enhance your practical skills by testing, refining, and implementing indicator-based approaches for consistent performance. From searching for nature's reflections in financial markets through patterns, market participants began questioning how to address the inherent subjectivity of interpreting shapes on price charts. One of the early pioneers of technical analysis, Charles Dow, the founder of the eponymous Dow theory, sought a simpler and more objective method of determining market trends. Recognizing the challenges in identifying trends and reversals purely from patterns, Dow proposed using the prices of industrial companies to create an index that could serve as a barometer for market sentiment. This idea led to the creation of the Dow Jones Industrial Average, originally composed of 12 prominent industrial companies spanning sectors like railroads, cotton, gas, sugar, tobacco, and oil industries, Dow viewed as the backbone of the U.S. economy at the time. From these humble beginnings of using averages, the field of technical analysis has evolved significantly, giving rise to a plethora of indicators developed over the last century, each offering traders more tools for objective market analysis. Early practitioners of technical analysis were primarily concerned with identifying market trends, determining when to join them and when to stay out. Building on the work of Charles Dow and his concept of indexing prices, these early analysts sought methods to filter out the noise of intraday price fluctuations. This led to the development of moving averages, a simple mathematical approach to smoothing price data over a specific period, allowing traders to better observe the underlying trend. Perhaps the most widely recognized technical indicator, often mentioned in financial news, is the moving average. In theory, measuring a price at regular intervals and calculating its mean provides a simplified representation of the overall dataset. By continuously updating this calculation over time, a process known as rolling the sample, you can effectively capture and reflect the changing dynamics of the price data. As previously discussed, moving averages are designed to help traders identify the prevailing market trend. At its most basic level, traders interpret the market as being in an uptrend if prices consistently trade above the moving average and the moving average line has a positive slope over time. Conversely, the market is seen as bearish if prices remain below the moving average and the slope of the line is consistently negative over time. From a trading perspective, this guides traders to focus selling opportunities when prices are below it. When the moving average line appears relatively flat, or when prices consistently cross above and below it without sustaining a positive or negative slope, this indicates a lack of strong market sentiment or momentum to establish a clear trend. In such cases, the market is said to be in a range-bound or sideways phase, where neither buyers nor sellers have a decisive advantage, resulting in limited directional movement. One of the most common applications of moving averages is using crossover signals to identify potential trend changes. In a rising market, if prices drop below the moving average, it is often interpreted as a signal that the bullish trend may be ending. Conversely, in a bear market, prices pushing above the moving average can be seen as a potential indication of the start of an uptrend. These signals provide traders with a straightforward method to assess possible shifts in market direction. The simple moving average or SMA is one of the foundational tools in technical analysis, providing traders with a way to smooth out erratic price movements and focus on overarching trends. By calculating the average price over a set period, the SMA offers a clearer picture of the market's direction. A rising SMA suggests an uptrend, while a declining SMA indicates a downtrend. Traders often rely on longer-term SMAs, such as the 50-day or 200-day, to determine the broader market trend. The formula for SMA is SMA is equal to the sum of A sub 1, A sub 2, and so on, up to A sub n, all over n, where A sub n is the price of an asset at period n, and n is the number of total periods. Note that the process is repeated at a specific period, rolling forward as new price data is available, creating a moving average. Beyond trend identification, the SMA also functions as a dynamic level of support or resistance. During retracements, prices often bounce off the SMA, creating opportunities for traders to enter or exit positions. Another common application of the SMA involves crossovers. For instance, when a shorter-term SMA crosses above a longer-term SMA, it generates a golden cross, signaling a potential buy. Conversely, a death cross occurs when the shorter SMA moves below the longer SMA, often interpreted as a sell signal. The weighted moving average, or WMA, builds upon the simplicity of the SMA by giving greater importance to recent price data. This adjustment makes the WMA more responsive to market movements, making it a preferred tool for traders seeking to identify short-term trends. While its purpose aligns with that of the SMA, the WMA's sensitivity allows it to detect momentum shifts more quickly. The WMA calculation differs from the SMA by applying a weighted factor to each data point. The most recent price carries the highest weight, while the older prices are assigned progressively lower weights. The formula for WMA is equal to P sub 1 times N plus P sub 2 times N minus 1 plus P sub 3 times N minus 2, and so on, up to P sub N, all over N times N plus 1 over 2, where P sub N is the price for time period, and N is the time period. Like the SMA, the WMA can also act as a dynamic support or resistance level. However, its greater emphasis on recent prices provides more immediate reactions to market changes. WMA crossovers are also a popular strategy. For example, when a short-term WMA crosses above a longer-term WMA, it often signals a buying opportunity. A crossover in the opposite direction suggests the potential for a sell-off. The exponential moving average, or EMA, takes the concept of weighted averages a step further, by assigning exponentially increasing weight to recent prices. This heightened sensitivity makes the EMA an invaluable tool for traders looking to capture trends and momentum shifts with greater precision. A rising EMA indicates bullish momentum, while a declining EMA signals bearish sentiment. The formula for EMA is equal to P sub T times K plus the EMA of the previous period times 1 minus K, where P sub T is the current price, EMA sub T minus 1 is the previous period's EMA, and K is the smoothing factor, which is equal to 2 divided by the number of periods plus 1. Note that the process begins with an SMA for the first period, which is then used to calculate the initial EMA. From there, the EMA is updated as new prices are added. The EMA often acts as a dynamic support or resistance level in trending markets, where price reactions around the EMA offer valuable insights for trade entries and exits. Crossovers between EMAs of different periods are widely used trading signals. For instance, when a shorter EMA crosses below a longer EMA, it suggests a bearish trend reversal or continuation. Similarly, when price crosses above or below the EMA, it reflects shifts in market sentiment, signaling bullish or bearish momentum, respectively. The Moving Average Convergence Divergence, or MACD, was developed by Gerald Appel in the late 1970s as a tool to analyze the relationship between two moving averages of a security's price. Unlike many other indicators that focus on specific price levels or identify overbought and oversold conditions, the MACD stands out by emphasizing the interplay between price momentum and the strength of a trend. At its core, the MACD addresses a key question for traders: is the momentum of the current trend gaining strength or beginning to weaken? The MACD is composed of three main elements. The first is the MACD line, which is calculated as the difference between two exponential moving averages, typically the 12-period EMA and the 26-period EMA. This line provides the foundation for the indicator. The second component is the signal line, which is a 9-period EMA of the MACD line itself. This line is used as a trigger for buy and sell signals. The third element is the histogram, a visual representation of the difference between the MACD line and the signal line. It oscillates above and below a zero line, providing insight into the strength and direction of momentum. When interpreting the MACD, there are several important aspects to consider. One is the concept of crossovers. A bullish crossover occurs when the MACD line moves above the signal line, suggesting that upward momentum is gaining strength and potentially signaling a buying opportunity. Conversely, a bearish crossover happens when the MACD line drops below the signal line, indicating that downward momentum is increasing and suggesting a potential sell signal. Another significant aspect is the zero-line crossover. When the MACD line crosses above the zero line, it signals that the shorter EMA is now above the longer EMA, which reflects bullish momentum. On the other hand, when the MACD line crosses below the zero line, it indicates bearish momentum, as the shorter EMA has dropped below the longer EMA. Finally, the histogram provides a visual cue for analyzing momentum. When the distance between the MACD line and the signal line increases, the histogram expands, indicating strengthening momentum in the current trend. Conversely, as the histogram contracts, it suggests weakening momentum, which could signal an impending reversal in the trend. By combining these elements, the MACD line, signal line, and histogram, the MACD offers traders a dynamic tool for understanding price action and identifying potential shifts in momentum. Early practitioners of technical analysis recognized that markets do not always trend in a single direction. Instead, prices frequently move sideways within a defined range, creating opportunities for traders who can effectively navigate these conditions. Building on the principles of price behavior and market psychology, analysts developed a class of indicators known as oscillators, a mathematical tools designed to help traders assess whether prices are too high or too low relative to their historical range over a specified period. Oscillators provide valuable insights into potential turning points in range-bound markets, offering clarity and guidance during periods of trendless or indecisive price action. These tools are indispensable for traders looking to capitalize on sideways market conditions where directional trends are absent. The stochastic oscillator, introduced by Dr. George Lane, focuses on the momentum of price movements rather than the price itself. Dr. Lane theorized that momentum changes direction before price does, offering an early indication of potential reversals. The oscillator is based on the principle that in a consolidation, prices tend to close near their highs, and they close near their lows. The stochastic oscillator consists of two lines, %K, which measures the closing price relative to the recent high-low range, and %D, a smoothed average of %K that acts as a signal line. Both lines oscillate between 0 and 100. When the stochastic rises above 80, it indicates overbought conditions and the potential for a price correction. Conversely, a reading below 20 signals oversold conditions, suggesting a possible price increase. Traders also look for divergences between the stochastic oscillator and price action. For instance, a bearish divergence occurs when the price forms a higher high, but the stochastic makes a lower high, signaling weakening momentum. The RSI was introduced by J. Wells Wilder Jr. in his seminal 1978 book, The New Concepts in Technical Trading Systems. Wilder's goal was to create a tool that could measure the speed and change of price movements. The RSI quickly gained traction among traders for its ability to distill complex price action into an easy-to-read oscillator. When the RSI crosses above 70, it signals that a security may be overbought, suggesting a potential pullback or reversal. Conversely, a reading below 30 indicates oversold conditions, implying the possibility of a price rebound. The midline at 50 often serves as a dividing line between bullish and bearish momentum. An RSI above 50 indicates bullish strength, while a reading below 50 reflects bearish dominance. By highlighting shifts in momentum, the RSI provides traders with insights into potential trend reversals and continuation opportunities.
Thank you for watching. To reinforce your understanding of this video, make sure to take the accompanying quiz pinned in the comment section below. And remember to like, comment, and subscribe for more trading content. Comment yes to get your free trading ebook.